Good morning and welcome to our HIA Ignite Long Island joint meeting talking about tax strategies for manufacturers. For those of us who are not CPAs and not financial folks, it's hard to keep up with, the latest and greatest as to what's going on. And I found for a lot of manufacturers, they just don't know about all the opportunities they may have to be able to save money on their taxes. So we're going to hear from a great panel today and hear about strategies that you as business owners, you as manufacturers should be keeping track of. What I'd like to do is start off by just going around the room and allowing people to introduce themselves so we better understand our audience. A couple of minutes ago, Patrick introduced himself, but Patrick, you want to introduce yourself one more time now that we're on the recording?
Well, good morning, everyone. My name is Patrick Boyle, Executive Director of HIA-LI. We're the manufacturing consortium for all products made here on Long Island. I get to go up to Albany and down to DC. I kind of beat the drum for anyone that's making a product here on Long Island. Working very closely with Ron, and I expect in 2022 we're going to be doing a lot of great things together. So thank you, Ron, for doing what you're doing. Keep up the great work.
Absolutely, right back at you. Again, keep hounding those folks up in Albany because that's not my gig. I prefer to stay down here on the island. Let's go around the room. Jeff Bergstein, could you introduce yourself? Just got to get yourself off of mute there.
Sure. Yep. Jeff Bergstein. I spent 36 years with Arrow Electronics, who in the year 2000 was the biggest sales company in Long Island, and then they moved, unfortunately, to Colorado. But I worked out at their Hot Park facility, and I ran their about $100 million OEM and export international operation. Since I retired in 2016, I was telling Ron, I do a lot of work in Manhattan and Brooklyn. I'm on 4 advisory boards for startups in clean tech, bio, med, and IoT, and I work for major product design firms and some major OEM clients and contract manufacturers on Long Island. So big in the technology world, a lot of contacts.
Great. Welcome, Jeff. Great to have you today. Let's jump over to Jamie Moore. If you could unmute yourself and introduce yourself, sir.
Sure. Good morning, everyone. Name is Jamie Moore. I run industry grants. I help companies out getting grants for growth, training, cost reduction programs for electric, et cetera. I work with Ron and Patrick a lot. And used to run the trade association, so I've walked a ton of floors on the island, and I'm always impressed and amazed at the work that's being done by manufacturers here.
Absolutely. Welcome, Jamie. Tony D'Agostino, you could unmute and introduce yourself.
Hey, Ron. My name is Tony D'Agostino. I work with Grassi and Company. I've been a CFO for most of my career. I worked at Sylvania up in Syracuse, Standard Microsystems here on Long Island, Todd Power Supplies here on Long Island, and Daddario here on Long Island. But I work now as a consultant and help some manufacturing companies through their issues.
Great. Welcome. Great to have you. Walter Green from FI, if you can unmute yourself and introduce yourself, please.
Thank you. Thank you, Ron. Good morning, everyone. My name is Walter Green, and I am with the FI Group. We are actually R&D tax credit consultants. I'm based out of New York. My managing director is based out of Chicago, and I appreciate the invitation. Thank you so much, Ron.
Absolutely. Great to have you. Ann Chibunka Moore, one of our manufacturers here on Long Island and a leader to try to beat the drum about Long Island manufacturing. Welcome, Ann.
Thank you, Ron. So I am the owner and CEO of GSE Dynamics with 2 facilities, of course, here in Hauppauge, and also the founder of Ignite. So obviously this meeting is important for me to see all those great faces out there. And Ron, you mentioned the collaborative effort of beating that drum and giving everybody shovels to play in the same sandbox. So I thank you for that leadership and for that tone that you set. I think 2022 will continue to be a very collaborative year, and hopefully answering the call of all manufacturers across all the different sectors, which I think is, again, one of the main goals, that we get and listen to everyone's needs and try and help you out and grow and get us through this crazy time. So thank you, Ron and Patrick, and really everybody there who continues to beat that infamous drum for us at Ignite. Thank you, Ron.
Absolutely. Thanks for joining us, Ann. Steve Gaskowitz, sorry, if you could unmute yourself and introduce yourself, please. And maybe Steve has stepped away. How about Bruce Bahar, if you could unmute and introduce yourself, please. All right, I guess we got a lot of folks that are stepping away. How about Ketki Gandhi?
Hi, this is Ketki Gandhi. I'm working with a Grassian company as a seasonal tax director. I have experience over 40 years in the tax compliances, and nice to join this seminar.
Very nice.
Thank you.
Welcome. Nice to have you.
Thank you.
David Teresiano, if you could unmute and introduce yourself, please, sir.
Yeah, I was a accountant, a CPA for a long time, still CPA, but working on my own. And one of my decided to get out of the public and go into private. So I'm now currently working with Exergy LLC.
Oh, excellent. Very good. Great company there over in Garden City. All right.
Yes, sir.
Jim Michelle, if you could introduce yourself, please. All right, Jimmy may have stepped away. How about, I'm gonna mess this name up, CJ Ma? You could introduce yourself. All right, CJ, I see you're unmuted, but we're not hearing what you're saying, but welcome to our meeting this morning. Tom Kreckler, if you could unmute and introduce yourself, please.
Good morning, everyone. I'm actually a tax and audit partner with Grassi up in the Boston area, focusing in M&D. So this is very interesting to me, and actually hoping to bring some of the strategy we talk about here up into the Boston area.
Super. Well, it's great to have you. I'm actually a New England boy myself. Grew up in Connecticut, worked at Sikorsky. So welcome from the northern climes. Helman Chica, if you could unmute and introduce yourself, please. And Helman may have stepped away. Let's move over to Joe Carnevale.
Yeah, Joe Carnival here. I am a tax principal over at Grassi. I actually represent the New Jersey office, and looking forward to hearing a bit more about the tax opportunities here, and hoping to bring it back to the folks over in New Jersey and take it from there.
Absolutely. This is all about sharing best practices, sharing information. It's hard for any of us, one person, to be able to have all the answers. So it's good to have a team to reach out to and rely on. Helen Torkos, our friends over at Regent Tech, if you could introduce yourself, please.
Good morning, all. My name is Helen Torkos. I'm the president and CEO of Regent Tech Industries. We're a manufacturer of pavement markings. We are the only Northeast manufacturer in the US, and we're one of 5. So we're excited to be here, and Long Island is our home. And right now we are really looking forward to getting some insight into some tax breaks and some anything else anybody else can offer actually for manufacturers. So thank you, Ron. Thank you for having us.
It's great to have you, Helen. Give our best to Danny and the family there. Jason Drucker, if you could unmute and introduce yourself, please.
Hey, Ron, this is Jason Drucker. I'm a tax senior manager over at Grassi, and I specialize in the M&D group with our team. I'm here today just to kind of listen into what everyone has to say about the upcoming tax year and some potential tax credits that we could utilize to help our clients save extra dollars and work that bottom line.
Great. Welcome. It's great to see all the Grassi folks enjoying us this morning. Mr. Browning, Ed Browning, if you could introduce yourself, please. All right, Ed may have stepped away. How about John Caniglio? If you could unmute and introduce yourself, please.
Hello, everybody. John Caniglio from Michael Products. I'm the CEO of Michael Products. We manufacture vent tents and pool covers based out of South Carolina and Long Island Grassi is our accounting firm and brought this opportunity up that I look forward to hearing. It's a little bit of change of pace hearing how maybe taxes could go down a little as opposed to going up, because most of my webinars have been about going up. So look forward to it.
Well, you came to the right place. All right, Frank Riolo, if you could unmute and introduce yourself, please.
Hey, my name is Frank Riolo. I am a audit manager at Grassi, and I'm looking to learn more about the different tax savings opportunities from this presentation.
Great. Good to have you this morning, Frank. Ken Simon, if you could introduce yourself, unmute and introduce yourself, please.
Hey, how's it going? My name's Ken. I'm a tax senior at Grassi, and I just joined to listen to, the more educated people speak, and hopefully I can learn a couple things.
Great. Welcome, everybody. Looks like we have not gotten our folks from HIA, but maybe on behalf of HIA, I can just mention a couple of upcoming events. It looks like the trade show this year is going to be in May, the end of May, and we're going to have it back over at Suffolk County Community College again. So I'd like to actually chat with some of the manufacturers, maybe offline, to talk about what would it be that be attractive to you? I know that, finding people, so labor is a big issue, supply chain is a big issue. So maybe there's an opportunity to combine this trade show into a job fair, sharing supply chain opportunities here with local manufacturers. So we'll chat more about that. So without further ado, let's get into the topics today, presentation. Let me introduce our panelists. We have Danielle Michelle Cpa, specializes in saving money for manufacturers. That's what we're all about today, right? She has a long history in the manufacturing industry. She's been in business for over 15 years, holding a variety of key management positions, including running the accounting and finance department of a multi-million-dollar design build manufacturing firm out east. She's also worked for some of New York's most reputable CPA firms, including a few that are here today. On both state and federal levels, there are programs designed to benefit manufacturers, which she focuses on increasing cash flow and maximizing manufacturing tax savings by staying up to date on tax laws and regulations. She's recovered millions of dollars for businesses, especially manufacturers, through the R&D tax credit, sales tax recovery, refunds, and employee retention fund and credit. We have John Giordano from Citron Cooperman with over 15 years of experience providing accounting and assurance services for middle market businesses. His clients span the manufacturing, distribution, construction, property management, retail, and wholesale industries. He also has extensive experience servicing closely held and private equity-backed businesses. As a leader in the firm's manufacturing and distribution practice, John serves as a specialist and go-to resource for his clients. He's been successful in building and maintaining close relationships with his clients by demonstrating a vested interest in his business, allowing services beyond the scope of a traditional CPA. We also have Shashi Singhal from Grassi. She's a partner at Grassi, brings over 20 years of diversified tax and accounting experience to the firm. And Shashi, I understand you've recently been promoted to partner, so congratulations on your promotion and keep up the good work.
Thank you.
Her expertise lies in review of tax returns, research projects, tax planning and projections, international tax planning and compliance, assisting in mergers, acquisitions, and corporate restructuring. Shashi works with clients primarily in the M&D, wholesale and retail industries, law firms, architects and engineer firms, real estate companies, family partnerships, and private foundations. And then finally, we have Don Crotty, CPA partner at MD Group over at Mazars, Long Island office. He's got over 25 years experience advising businesses and high net worth individuals on tax minimization, deferral strategies. Don experience includes state and local taxation, credits and incentives, merger and acquisition planning, due diligence, real estate, cost segregation, financial management, tax reporting, and employee stock ESOPs, employee stock ownership plans. He also represents clients with federal and tax examinations. And Don frequently speaks on a variety of tax topics as tax reform and year-end tax planning. So let's jump into our panel. Let's start out with Danielle Michelle. Many manufacturers I speak to are unaware of their ability to take advantage of R&D tax credits. They think you have to be, mixing chemicals and, designing the latest vaccine or whatever it might be. But there's opportunities there for manufacturers, which you could talk about. Also, the employee retention tax credits, the sales tax recovery. Is it too late to receive a employee retention tax credit or refund? And Danielle, you have to unmute. Thanks.
Yep, you got it. Thank you so much. Good morning, everybody. Thanks for joining us this morning. So I'd love to touch on those two topics that you just mentioned. I'll start with the latter, the employee retention credit. It is too late to take the employee retention credit as a credit, but you can still get a refund for retaining your employees. So I'll explain to you what that means now. So for those of you that are unfamiliar with the employee retention credit, what it is it's a refundable payroll tax credit that the IRS is refunding to companies for paying payroll taxes during the pandemic and retaining your employees and keeping them on payroll during these difficult times. The credit can be substantial, where you can get up to, if you maximize the credit, up to $26,000 per employee. That's for 2020 and 2021. There's a few ways to become eligible. The two main ways is, one is if your business had to be shut down at any point due to governmental mandates. So in certain states, for certain industries, they were more affected than other states and industries. So a lot of manufacturers still had to stay open, but if your business was affected substantially enough where it wasn't fully shut down, but still affected where you weren't able to operate normal business operations in the manner that you usually do, there still could be recovery from a governmental standpoint. The second way to become eligible is through your sales. So this whole employee retention credit, the way it works is it's tested on a quarterly basis. So similar to the PPP loans, round one, round two, where you had to do a comparison and compare quarter of 2020 to 2019. Same thing with this. It's 2021 to 2019 as well. 2019 is the baseline. So the quarters that are available for recovery is all the quarters in 2020 from March 13th, 2020 until the end of the year. And then for 2021, the first 3 quarters are eligible for this recovery. And the way it works is there's a cap for each quarter. So I said $26,000 earlier as a maximum, the max that you can get per employee for this refund check that the IRS will actually write a check and submit to the company. And the way that I come to that number is you can get $7,000 per quarter for 2021. There's 3 quarters. So the first 3 quarters, so $7,000 plus $7,000 plus $7,000. That's 21. And then for 2020, it's up to $5,000 for the quarter or for the year. So the $5,000 for the 2020 and then the $21,000 for 2021. So like I said, the eligibility is there based off of either decrease in sales. You have to meet certain standards of percentages, but if you meet at least one of those quarters, you can become eligible for more than one. So if you're Googling it online, you may see it as a 20% decrease for 2021, comparing one quarter when you look at 2019, and you're thinking every quarter you have to hit that 20%. But that's actually not the case. So if you get 20% in one quarter, you could automatically become eligible for the second. So we could talk about that in more detail for anyone that's interested for themselves or for potential clients. But while the credit is out there, this is actually a refund now because we're talking about past tense, because now we're in Q1 of 2022. So these time periods I'm talking about are all prior. So I'd like to give you some examples on that. And then something, I know a few people in this group work with like more startup companies as well. And you could have an existing business that you started during the pandemic for operations. And there's a different type of employee retention refund available for those companies. So I'm going to share my screen. So I just think it's easier to see numbers So you could really understand the magnitude of the value that we can get here for the refund. So hang on one sec. And okay, so I'm going to show you first. Do you see my screen? Everyone good?
Yep.
Okay. So the first case study is based off of, this is a CNC manufacturing company. We're talking manufacturing here because that's what we're focused on. And that's what most of us specialize that are on this panel. But in reality, it doesn't matter what you do as a company. It's just that you meet the standards that I discussed earlier through governmental shutdown or decrease in sales. And in this specific example for a real client that we have, this is a CNC manufacturing company. And they had, if you look on the bottom right, that you could see there, the employee size was only 9 full-time employees. So the employees do have to be considered full-time, which is 30 hours or more per week or 130 hours for the month. And this was for the 2021 tax year we did this for, and their result ended up in almost $130,000 of a refund check across the three quarters for 2021. So they didn't have the eligibility for 2020 because it's a more significant decrease of 50%, and they didn't meet that. And they were not shut down because they were considered essential due to the businesses that they manufacture for. But just for those 3 quarters with 9 employees and a PPP loan, they were able to get almost $130,000 of a refund check. So these numbers can be substantial and shouldn't be ignored. And then this is a gym, and the reason why I know, again, we're talking manufacturing, but it doesn't matter what we do here. It's just the process. So with this example, I just wanted to discuss it because this gym here actually is opened in Long Island, and they were set to open in March of 2020. That wasn't able to happen due to the pandemic because gyms had to be shut down, all gyms and restaurants. So they were shut down before they even opened. They just didn't open, and they weren't able to open until I think August of 2020. And because of that, they're automatically enrolled into a different program, which is called the Employee Retention Recovery Startup Program. And what that means is the criteria is a lot more simple and straightforward to become eligible for that. There's 2 criteria. One is that the business had to start after February of 2020, meaning like the operations started. So you could have incorporated it years ago, but actually starting the business, like in this case, they did that. They actually started it in August of 2020. And then the second thing is that the annual gross receipts, the sales, have to be under $1 million, which, I mean, most companies, when they're starting a company for the first year, that's going to be the case. So what happens there is they're automatically eligible for Q3 and Q4 of 2021. Only those 2 quarters you're eligible under this program, and there's a max of up to 50 grand per quarter. But again, you can get up to 7 grand per employee per quarter. So for them, the max per employee could be 14 grand because you have 2 quarters you're talking about here. So for 7 full-time employees, they have 2 quarters worth, and their result is $77,000. So again, substantial for them. So that's a significant amount of money for them that they had to hire employees. They kept them on staff during difficult times, and they're able to use that to help fund their payroll or whatever for their business operations. And it's current money. So they could have taken that as a credit, but they wanted it as a refund. So we filed it subsequently, and they got a refund. They're getting a refund check for that. We're still waiting on the Q4 version of it, but we know that it's going to go through. So that's how the employee retention credit works. In a nutshell, it includes the process of amending the 941s, which are the quarterly payroll tax returns for any of the quarters that you're asking for the refunds for. And it's done through the IRS from a federal standpoint. So each quarter will come back as usually separate checks, but because they're being analyzed per quarter. So that's the way that works. And then to answer Ron's, or to discuss Ron's first point about the research and development tax credit, that's another great point that he made, that a lot of companies don't realize that they're eligible. When you hear research and development, a lot of people's minds go to like a laboratory setting. You think of the people that are in the science labs right now creating a new Omicron vaccine that's supposed to come out in March, and they're fully eligible for R&D, I'm sure of that. But in addition to that, it doesn't matter what you do, it's how you do it. So you can be a mobile app developer, you can be a manufacturer that has product lines where you've had the same 20 products, but you're making enhancements and improvements that include some kind of testing. And it's not just for aesthetic purposes where you're changing a product from one color, from blue to black. But you're doing more than that, where you're bringing up some kind of CAD design or simulation software, and you're looking at the work that you're doing. So if you're enhancing an existing product or creating a new one or process that's included into developing a new product or process, those are all activities that can be included in the research and development tax credit. And the way that works, for those of you that aren't familiar with what it is and you just hear tax credit, it's different than the employee retention, where it's not going to be a refund, it's a credit in the current year. You can go back 3 years, but that would require amending returns. But to talk about the credit, which is the current year situation, which most companies, it's a first step in getting that benefit, is there's 3 things that go into making up this research and development tax credit. One is payroll. So the people that are on your payroll that are involved in making decisions, brainstorming meetings, your foreman in your manufacturing shop, your supervisors that are making decisions, whoever you have heading up product development, the owners. The payroll that you're paying these people is really done through payroll and percentages of time. So maybe the owner does 50% sales and 50% of his time or her time is into product development and problem solving. So maybe we take 50% of their salary once we do an analysis and all that. And your foreman, maybe part of their position is more supervisory skills, where they're just overseeing the current process, but maybe 20% of their time goes into enhancing new products, problem solving, making new decisions, testing out new materials, things like that. So you can take a percentage of their time, and payroll is the biggest benefit. The second thing is cost. So any cost that goes into the process for development, where we're going to call it R&D development, is also included. So that can be like any materials that are used for prototyping or anything. Once it gets to operations, the cost stops. So when you get to the point of operations, now it's normal business operations and it's not considered R&D, but everything leading up to the point where now you're making these widgets over and over again and doing the same thing. And I know someone mentioned pool covers earlier. So now you have a pool cover and you're just replicating it at that point. That's no longer R&D. But when you're creating a new, let's say, pool cover to say relevant, and you're making this one more durable, you're enhancing safety on it, you're changing the hinges, again, for safety issues, or you're dealing with different areas of weather, like where you have more substantial weather, that you have to make these covers more durable versus other parts of the nation. And that's something that you're working on doing. So all that time, whomever's involved in that process, the costs that go into that are all included in R&D. And the third thing that goes into making up this credit, the dollar, is subcontractor costs. So we talked about direct payroll, we talked about subcontract costs, and now subcontractor cost means that if you're subbing somebody out or 1099ing someone that's not on your direct payroll, that's also can be included at a discounted rate. It's right off the bat, we take 65% of the costs, and we start there for an analysis, but their costs as well. If you're having like testing labs, or you have to, like, again, pool covers, like you had to do some kind of test where you had to have like a weighted test to see like how much weight it can prove, and you want to, so you can market that and say, this is what we do, and you also want to prove it out. That testing lab, or whomever you're hiring to do external third-party testing, could be involved in the R&D, and those costs can be captured as well. So we'd be talking about the current tax year, and the end result ends up being one number that goes on your tax return. There's another form that has to get filed, is Form 6765, and your CPAs will take care of that. Your normal CPA. So what we do is we don't do your tax returns. We do that one portion that goes into your tax return, and work with your CPAs to get that number for them. And that can offset dollar for dollar tax liability owed. And if you can't use it all, and let's say we got 100 grand of credit and you only owed a tax liability of like 50 grand or something like that, and it could flow through to the owners based off of the way the company is set up as LLC and partnerships and stuff like that. And you can't use the whole thing. You can carry it forward for up to 20 years, which is phenomenal. So that you can always have this rolling credit. If you can't use the whole thing, you want to capture it while the costs are there, and the years that you're expending those costs, it's super important. So I'm just going to give you 2 examples really quick. I'm going to show you on my screen. Again, I just think it's easier to see the numbers that way, so you could understand the numbers from a bigger example to a smaller example for real clients that we have. Okay, so this case study is, this is from last year, so we're doing their engagement again now. But this is an exterior wall panel manufacturer, and this is a larger credit. There's about 550 employees in this example, and their revenue is about 150 million in sales. And on their staff, they have a lot of different types of engineers, from a structural standpoint to civil, because they're manufacturing, they're doing design, build, manufacturing. So they're designing the exterior wall panels for different types of material, like curtain wall, terracotta, mega brick panels, etc., all different types. They're custom builders, so everything they do is custom to that project, and they work on some of the major projects in the Northeast for a commercial standpoint, from different types of colleges, hospitals, entertainment centers. You would know the names, but we'll keep those confidential. But anyway, so on staff, the reason why the credit is so big, because they have higher paid payroll, where they have those structural engineers and, you know, 6-figure salaries, design engineers. And then in addition to that, besides those higher paid individuals, they have their regular manufacturing employees, which make up majority of their employees, maybe 400 to 450, I would say, probably in their manufacturing shops. So a lot of them are laborers, and they're not adding to the R&D process besides following direction. But they have maybe like 10 different foremen and supervisors and managers over them, depending on what hangar they're in, because they have multiple hangars and departments. So they're able to get a large tax credit of $753,000, almost $1 million a year. They plan their tax year around it, you know, knowing that every year they're able to get at least this amount, as long as they're growing and not making any decrease in changes to their payroll or what their operations. So again, they plan their entire tax year based around the R&D credit, because it's substantial for them. Then we have clients like this is one that Ron and you worked on, which ended up into a bigger engagement, because as I mentioned earlier, you can go back 3 prior years, which would include amending returns in addition to the current year. So this one we've had as a client for a few years now, where we do their current, but this is actually a technology software integrator, and we have all different types of manufacturers. And just to show that you don't have to be just a manufacturer, it's what you do, not it's how you do it. It's not what you do. I'm sorry. So they're able to get, on average, we get about $150,000 a year, because they have about 30 employees in size, which is a lot smaller than the other company I mentioned, but it's substantial for them, because $150,000 on a $25 million revenue standpoint, it's really something that, again, they plan around, and that flows through to there's 2 owners, so it flows through to them. We're able to go back 3 years, which did get approved. It took extra long because we filed everything right before the pandemic, but it's approved and processing. So you know, those things are inevitable, as we all know, the unforeseen there. But yeah, so they'll be able to get $450,000 for the prior 3 years. And then we're doing this year in February, we're doing their engagement, and we're expecting to get around $150,000 for them for developing software. So they have, it's mostly payroll for them. It's their staff that's making adjustments to their current integration software that they have. And they have like a little testing lab in their facility, where they like mimic environments, because they have some of the major companies like Fox, Disney, stuff like that are their clients. And they do integrations when like one company takes over another office or buys one out. And that all has a testing environment and process that isn't straightforward, but when you learn it, it's super interesting. So again, it's what you're doing throughout the process, how you're doing it is what makes you eligible. So if anyone has any further questions after this, I think there's going to be a Q&A at the end, or I'd be happy to share my contact information if you have a specific scenario for yourself or for a client. More than happy to talk to you one-on-one about that as well.
Yeah, absolutely. If you have questions as we're going through the presentation, if you could drop them in the chat, and we could present that to the panelists. Thank you, Danielle. So, as you can see here, there's some major dollars available to manufacturers or anybody, software developers, anybody who's experimenting and creating new products or customizing, or the big thing that I think a lot of people miss is, those of us in the industrial engineering space, the work that we do also counts towards, process improvement counts towards the R&D tax credit as well. So, make sure you run that by your CPA, or if you need outside help, we'd be happy to help you with that as well. So let's
Ron, can I just jump in real quick?
Yep.
Yeah, because I worked a lot with Danielle on these credits, both the R&D and the ERC. One thing, there's a lot of misconceptions out there about them, as Danielle covered only a few. So when I'm advising my clients, I'm sure Grassi and Mazars are on the call as well. Don't let the client make their own decision about it. I speak to the client, inform them of somebody that's a specialist about it, have the conversation, have the dialogue, because some of these are not, especially when it comes to the ERCs, it's not clear cut. There's other ways to deem yourself eligible. So definitely have those conversations, explore them with Danielle. And the same on the R&D credit. One of the big changes with the ERC, I should mention, is that a lot of people didn't pay close attention to them initially because you couldn't do PPP and the ERC together. You had to pick one or the other, in a sense. That changed all the way back in December, but still, it's one of those things that if you're not monitoring it as closely, or you don't have an advisor that's advising you about it, it could have slipped through the cracks. So now, even if you took PPP, you could still be eligible for employee retention credits. There's some, it factors into your calculation of what you're eligible to take, because you can't double dip on the wages that are used for both, but it's still worth the conversation. It really is. And the R&D is the same. Like, I know Danielle mentioned it, Ron, you said it. You don't have to be cracking the atom here. Have that conversation. If you're doing something process-wise or just altering your business, have the conversation. It takes half-hour tops to just explore it. Danielle's a consummate professional. She'll tell you, hey, you might be wasting your time, or well, I don't see it here. Or, hey, you know what? If you send me this, this, and this, we can keep going down this, down this path and see if ultimately at the end of the day, there's a credit available for you. So sorry to jump in and disrupt the flow of things, but I just wanted to make sure that we didn't move past this without getting those few comments in.
Thank you, John. Thank you. No, and like John said, I didn't cover a lot of the specific challenges, but there are, like he said, things that aren't straightforward. Like if you don't meet like the eligibility from the two things that I discussed, there are ways that John and I are working legitimately and creatively for some of his clients to prove out. It's specific by the governmental body in that state, and each state and each county is so specific and so different. And think about it, like you look at like Texas or other areas like South Carolina or whatever, and they didn't shut down at all. So the constraints that happen here in Long Island are a lot more significant than they were in other areas when it comes to the ERC. Having advisors that these clients trust, when I come in, they don't know me from a hole in the wall. So they'll always say, I need to talk to my CPA. So it's great that John and his team are on top of it, and they bring us in being proactive versus reactive, so that they could try to maximize the benefits for their clients. So that's to make sure that even if it's a no, maybe it's not a no, and maybe we could turn it into a yes, rather than what you're reading on Google or through an article or something like that. So thank you for explaining that further.
Yeah. And in the interest of full disclosure, I guess I'll be the bearer of bad news here. These employee retention credits that differ from the PPP in the fact that they will result in taxable income, in the sense that you do have to reduce the wages for these credits. So you're reducing the deduction, which in some cases, depending on the quarters you're taking, could result in amending some prior returns. So that is one big difference between the PPP and the retention credits, is that the PPP, as we know, if they're eligible for forgiveness, they resulted in non-taxable income, whereas these retention credits, it'll be a reduction of the expense resulting in higher income for that period. Still,
Yeah.
I mean, you could do the math any way you want. It still results in net cash in your pocket, especially for companies that need it.
Yeah, exactly. And even the R&D, they actually, if you go on the IRS website, they recently updated it that you can't it's all about not being able to double dip. So it's like you can't take ERC wages and use that in R&D now. So there's a lot of great things and you can take them all. It just, you have to be careful and make sure that you're doing it the right way, like John said, to record the income the right way and reduce the wages where that's necessary. And that's why it's so important to have professionals that understand the latest and greatest, because it's changing constantly. So I mean, they rolled this thing out with the ERC through the fourth quarter of last year of 2021, and then through the American Rescue Plan Act, and then they revoked it. So, you know, people were halfway through the quarter and they said, you know what, never mind, we actually need that money for funding because we have a new bill coming out and we need to figure out alternative ways to fund that bill. And that's what they did. So these things are constantly changing. So I have CPAs calling me up saying, I heard the employee retention credit is done. How are you still filing it? Because it's misconceived that you can't take it as a credit because there's no more quarters right now unless they change something, but you can take it as a refund. And like John said, that you have to be careful for the prior years, for the closed tax periods of recording that the correct way. And that's why it's important to have the right CPAs overseeing that process for you.
All right, so lots of great information here. Go ahead, Don. Sorry.
I just wanted to, I mean, thanks, John, for bringing it up. It's usually the tax people that bring up the bad news. And to further that, what we're seeing our clients happening, you know, they're filing those amended payroll tax returns to claim the credits, and the credits for 21 especially are substantial. It is taxable income, but we're also seeing is that the IRS is taking a real long time in processing those amended returns. They may not get that refund till well into next year, but they may be paying taxes on it now. So that it's a challenge for our clients, and clients are getting frustrated because they file their amended returns like, where's my refund check? And they may not see it for a while. So it's a bit of a challenge that our clients are facing with dealing with and CPAs as well.
Well, especially because in 21 it's going to result in additional taxable income.
Sure.
So you know the cash delay in the government giving you a refund, but yet wanting your estimates and wanting you to pay when it comes to going on extension or filing timely, it's going to be a challenge. And that's why we're trying to, you know, it's bad news, but we got to be in the forefront of it. We got to educate our clients. As you guys know, you know, you don't want to make that phone call on the day that everything's due and say, oh, you owe X, Y, and Z because of this. And they didn't even know it was taxable to begin with. So.
Yeah, and I just want to make a quick point there as well, that there are other credits out there too, like the WOTC, the work opportunity tax credits, the family paid leave credit. And there is you have to keep in mind that you can be taking the same payroll dollars for all the different types of credits. So you have to carve out and keep, say if certain payroll or wages qualify for certain credits in like the WOTC credit, then you can really take those again for the ERTC and stuff like that. So we have to be mindful of those as well.
Ron, you're on mute.
Sorry about that. Yeah, so as we see, a great topic of conversation, great opportunity for savings there. So, you know, if you're not taking advantage of these credits, then certainly talk to your CPA, or even better, you know, to reach out to the experts here, and we can help you out with that. Let's move along to accounting changes going on. John, tell us about the lease accounting changes that are taking effect in 2022.
Yeah, thanks, Ron. I know this is primarily related to tax, but you know, we want to make sure that as we get these groups together, we educate on all things accounting. One of the major changes, I know a couple of years back we went through ASC 606, was a revenue standard, pretty significant to the accounting industry. Coming down the pipe this year, it's been deferred a couple of times, but ASC 842, accounting standard codification 842, relates to leases. So this is effective as of the first for most of our clients that are calendar year clients. So while it's not related to the financial statements that we'll be issuing for December 31st, 2021, it will be for any interim reports that are going forward. Anytime that the bank that you have to provide information to the bank, these standards should be implemented. And what they are is it's basically taking a new look at where you record leases. So in the old school way of accounting, you had two types of leases. You had capital lease or you had an operating lease. Capital lease, as we knew, went on the balance sheet as an asset owned by the company, or not owned by the company, but an asset of the company with the respective lease liability. The operating leases, though, were expensed directly through the P&L. There was no asset, there was no liability. It was essentially just an expense as it ran through. A lot of those leases related to buildings, you know, as people lease warehouses, people lease equipment, people lease trucks. So depending on where they fell, and 840, which is the prior standard, had a lot more clear-cut measurement of how they qualify, whether it be a capital lease or an operating lease. Under the new standard 842, all leases that extend over 1 year need to be evaluated as to whether or not they are a capital lease or what's called now a finance lease. Finance lease will be what is the old school operating lease. Like I said in the past, this used to just be run through the P&L as it was expensed as incurred. There was some accounting surrounding it, such as deferred rent, whereby if you had some free rent periods, it was straight lined over the period of the lease. But now with this new accounting change, even those leases, including your warehouse leases, forklift, any lease, copier leases, you know, people think, I know it's crazy to think about, but these types of leases are all require accounting consideration and are going to have to go on your balance sheet as a right of use asset and respective liability. So whereas in the past, you just had to disclose these types of leases and the future commitment surrounding them, now the accounting guidance is saying these leases have to go on the balance sheet. So you have to show the asset and the liability. While this is taking quite some time to get up and off the ground, they've been talking about this for quite some time. There's been a lot of pushback from the industry in terms of why this is needed. It's going to, you know, create all kinds of confusion on the balance sheet with lenders, users of the financial statements, because it's going to gross up the assets and gross up the liabilities. And again, there was not a lot of understanding as to why this is required. This standard is a convergence effort with IFRS. IFRS and people that file into IFRS, which is the International Finance Reporting Structure standards. I'm sorry, they're already doing this. They're already showing the assets and liabilities on the books. So again, this is a FASB convergence project with them to more closely align the reporting standards and get more global reporting. The tax impact surrounding this is that although these assets are going on the books as right of use assets, they still have to be treated as operating leases for tax purposes. So you can't, just because you're grossing up your balance sheet for, let's just say, a warehouse lease, that you can't take any accelerated depreciation. I know Shashi's going to go into 179 other accelerated depreciation later. So these lease standards, even though they're creating new quote unquote assets on your books, these right of use assets, they do not provide tax benefit as of yet. All of this will have to be unwound for tax purposes. So, you know, as we educate our clients on this new standard and how it's going to roll through, we'd like to give them a complete picture of what the year is going to look like. You know, you're going to have to do all this work for financial reporting in terms of grossing up the balance sheet for these assets and liabilities. But when it comes tax time and we do tax planning, we're going to have to take account that a lot of this is going to have to be unwound, and you're going to have to go strictly to what was paid for these types of rents in the future. I know I said a lot there. I typically to move pretty fast. I apologize. If there's any questions or anything like that towards the end of now or towards the end, I'd be happy to discuss further. But like I said, it's changes that are coming, and the reason why we want to educate our clients on it is because although it is effective 1/1, or technically, it's December 15th, 2021, any periods after there, but most of our clients are calendar year. So I'm speaking to the calendar year. A lot of our clients have mid-year reporting to banks, to other lenders, whether it be other stakeholders that want quarterly or semi-annual reporting. So these technically have to be in there. So it has to be something that has to be considered throughout the period.
Thank you, John. Once again, I think, for us non-CPAs, it points to the fact that you really need to lean heavily on your tax professional and your accounting professional. Make sure that you're staying out of trouble and again, taking advantage of all the deductions and credits that you might be able to use. So let's move on to Shashi. Can you tell us about some tax reductions that manufacturers should be paying attention to if they're purchasing equipment? Things like the Section 179. Shashi?
Yes. Hi, good morning, everyone. And Ron, thank you for having me here. We will definitely would like to discuss certain tax deductions and tax deferral strategies with respect to property, plant, equipment, real estate that manufacturers can, developers of real estate as well as manufacturers can take advantage of. And I would just like to quickly share a couple of PowerPoints just to show some key amounts and date thresholds that we want to discuss. So give me 1 second. I'd like to share my screen there. And okay, is everyone able to see this slide? Okay, good. So let's talk about 179 and bonus depreciation. And basically, we know that 179 allows Section 179 deduction is an expensing provision which allows taxpayers to pretty much deduct the cost of certain tangible property that they may purchase for use in the trade or business. And it is available as a deduction when it is placed in service. So placed in service is very important. And a key point that we want to bring to everyone's attention is that in today's environment of all these supply chain issues, if you are thinking about making a capital expenditure, sooner the better, because you don't want to be stuck at in the fourth quarter towards the end of the year where you have an order placed for a big huge plant or machinery equipment and you're not getting the delivery, you can't place it in service, and so you're losing out on big deduction there. So it's important to note and keep in mind of all these business decisions where there might be supply chain issues, things like that, to make sure that you have enough time during the year, and sooner the better, that any capital expenditure decisions are made. Talking about 179, the maximum deduction available for 2021 is $1,050,000. And that is increasing in 2022 to $1,080,000. However, for 179, there is a spending limit or a spending phase-out limit threshold where if the total capital expenditure for the company for 2021, the limit is $2,620,000, increasing in 2022 to $2.7 million. So if the company is expensing or purchasing more equipment or any qualified property, tangible property, in excess of these limits, then the Section 179 deduction begins to phase out dollar for dollar. So for example, in 2022, if you're spending more than $3,780,000, then you probably will be phased out and you can't take the 179 deduction in that year. However, there is the other bonus depreciation that will be available. And if you look at the chart, bonus depreciation, again, need to pay special attention to this year because the Tax Cuts and Jobs Act added actually increased the bonus depreciation for years up until tax year 2022. So if you have any property, qualified property placed in service up until the end of 2022, you get 100% bonus depreciation on that. And that begins to phase out every year beginning January 1st, 2023 onwards. So it begins to reduce or decrease every year by 20%. So you see in 2023, the deduction is 80%, 24 is 60, so on and so forth. And in 2027, it completely is gone. So again, if you're making any decisions or planning for the next 5 years regarding any capacity expansion or any capital expenditures, then you need to make sure that you accelerate those decisions and take advantage of the maximum deduction that are available now. 2022 being the last year for 100% bonus depreciation, and so that's a very vital and important decision that you have to make. Couple of key or points or differences between 179 and bonus depreciation. So we get the question like, okay, if the same item of property or equipment, furniture, software, or computer equipment, etc., is qualifying for both, say 179 deduction and bonus depreciation, what would you take? So the question then becomes is that the preference or the order is always go for 179 first, then bonus depreciation, and then regular depreciation in that order. But there are certain limitations in terms of 179. As you see, there's a dollar limitation on the deduction itself for 179, as well as there's a spending limitation there for a phase out. In addition to that, there is also another limitation, which is a business income limitation, meaning, in other words, a business needs to be profitable in order to take the 179 deduction. If business is making losses, then you can't really take the 179 deduction. There are certain items that are considered as an add back, like owner compensation would increase that limit, but there are certain things to keep in mind when you are making those decisions. However, if say the business is making large capital expenditures beyond these spending limits, then of course bonus depreciation becomes useful in that case. And basically it will provide more of a deduction in terms of larger companies making larger capital expenditure items. A couple of items to keep in mind are that the other consideration is also that for bonus depreciation, since New York does not recognize bonus depreciation, you have to add the deductions back. If you're taking bonus depreciation on your federal tax returns, you have to add them back at the New York state level. So that is always a major consideration when you're making those decisions, because there might be certain passive activity loss limitations for certain owners and things like that. So you have to consider various items in terms of what is the structure, what is the ownership structure, how many owners are there, because these limits, especially in terms of 179, they apply at the owner, that is the partner or the shareholder level. So they may be getting deductions from several companies that they may be owners in. So you have to be mindful and make sure that you consider all these different scenarios and then make the decision. Sometimes a decision may be good for minority owners, but that might not always work out for, say, the majority decision makers. So then it all depends. Okay, somebody loses, somebody has to, but it has to be an overall decision when you consider all scenarios and not just based on certain isolated items. That's important key there. So the Tax Cuts and Jobs Act also kind of expanded certain items that you could take 179 on. And I just want to mention there, you have certain items in terms of commercial, not residential, but commercial non-structural improvements such as roofs, HVACs, fire protection, and alarm and security systems, they would also qualify. So keep those in mind, not to miss out and keep, leave those good deductions on the table. Always make sure that you consider all items that would qualify. That's pretty much it for 179 and bonus. Of course, certain items in bonus depreciation, we had that situation a couple of years ago when TCJ or the Tax Cuts and Jobs Act changed certain definitions of qualified improvement property and left out the 15-year property. And there was a huge problem with tax planning and whether we can take it or not. And then, of course, with the pandemic, CARES Act came along and made that technical correction. And business owners and companies were able to take bonus depreciation on leasehold improvements that qualified as qualified improvement property, and were able to take bonus depreciation. They could go back, amend returns, or even do a 3115 method change to take those catch-all depreciation deduction. So there was a lot of things. There's a lot of things going on in the last 2 years with so many tax law changes, but we try and stay on top of everything and make sure that we can bring all the different tax efficient strategies to our clients. So we were able to save a lot of dollars there by going back and looking back into previous years' depreciation schedules and things like that.
Yeah, that's great. Can we jump over to cost seg? You know, I've heard about this term, but you know, when do you make decisions to do that? When does it make sense to go into cost segregation studies?
Certainly. So cost segregation study is such a valuable tax deferral strategy. It's such a good tax break for real estate developers or owner of real estate property. And basically, if you see, typically a building structure would be depreciated for commercial properties would be depreciated over 39 years, and residential properties would be depreciated over 27.5 years in absence of a cost segregation study. But what cost segregation study does is that it breaks down the cost of the structures into different components, and based on engineering studies, of course. It's not something that the owner can do themselves and say, okay, you know what, I like to assign 30% value to a 5-year or 7-year property. It's based on engineering studies. And so basically, engineers come in, look at the structure, and they break down the cost into various components, various units of property. So a structure is typically made up of several components, like the HVAC, the plumbing systems, the electrical systems, land improvements outside of the structure itself, maybe parking lots, sidewalks, fences, things like that. Even with the interior, there are so many items that could qualify for a 5 to 7 year or 15-year life, where you can take accelerated depreciation. So items like, interior items that are non-structural. So what's important to note is non-structural items is what they look for and try to segregate those items. Items like electrical connections that are dedicated to certain, say, data processing or office spaces, although it's a part of an electrical system, which could be considered structural overall if it was a general electrical system. However, certain dedicated switches and outlets and certain dedicated electrical connections, in case of, say, a manufacturer, you have a freezer or certain processing area, and there has to be a certain dedicated electrical that could qualify for a more quicker accelerated depreciation life. Carpeting, interior panels, and temporary partitions, things like that, these all qualify. So there's a lot of things that can be taken advantage of over here, and nonetheless, it's goes without saying, these result in tremendous tax savings in the beginning years of buying the property, and it's all time value of money if you think about its present value, and the deductions that are available today are valued and worth more than what's available, like, say, 39 over 39 period, a 39-year period. So in terms of cash flow benefits, there's a tremendous upside there, getting a cost segregation study done. Now, you asked, Ron, about when is a good time to do it. So basically, the best time to do a cost seg study would be when the property is either purchased or a major renovation or remodeling is done. So that's the best time. However, if the building is already maybe placed in service years ago, they did not know, they were not aware of certain, this particular cost seg deferral strategy available at the time. So what they can do is they can always do a look back study and take the lost depreciation or a catch up depreciation, if you call it that, with a section 481A adjustment by filing a form 3115. 3115 is basically letting the IRS know that you are changing the method of accounting for certain property items that were previously qualified or taken as or classified as 39-year property are now broken down into components of 5, 7, and 15 years. This is an automatic change. So there's no IRS, IRS is providing an automatic consent. So there's no special consent or filing fees required. And we have been able to save tremendous amount of taxes for our clients that have manufacturing facilities, warehouses, supermarkets. I mean, wherever you have like a huge setup where you can find different components, it's always recommended to do a cost seg study and not leave that big deduction on the table, especially in the early years in the startup, in terms of startup times where cash is important for manufacturers. They need those cash flows, and this brings it to them. So.
Absolutely, really good to know. Can we just circle back to the section 179? Jamie, did you have a question about limits?
Oh, yes.
Got to unmute.
I
you.
can figure out how to unmute, yes. Yeah, I was curious, if you go over the limits of the 179, there's a New York State investment tax credit that doesn't make any sense to utilize if you're using the 179, but is it allowed to be used if you do go over the limits for that excess?
Well, if you are going over the spending threshold limit in excess of that, so say if your overall capital expenditure is in excess of the limit, then it's phased out. Your deduction is lost. However, if you have a 179 deduction that you were able to get it, but it is limited because of business income limitation, meaning you did not have enough profits in the business that year, then the certain portion of that deduction will be carried over to the next year. But it's always better to look at other options available and not leave anything for carry forward. Why leave something for next year when you can take something else today? But again, bonus depreciation may not work out in certain cases where you have obviously the add backs to consider at state levels and so on and so forth. But of course, if it's over the threshold, the spending limit threshold, then it's lost.
Great, thank you, Sakshi. Another thing that just came up recently was the New York State pass-through entity tax. And I know there was some kind of election you had to make before the end of the year, but tell us what that is, because that's a new wrinkle that IRS is throwing at us, right?
Absolutely. But in a good way, actually. So basically, if you remember with the Tax Cuts and Jobs Act, there was this limitation placed on the deduction of state and local taxes to $10,000. And so if you're taking itemized deductions on your tax return, and if you have taxes paid to New York State of say $300,000, $400,000, and you have real estate taxes of $50,000, $60,000, you're all limited to a $10,000, and that's it, a mere $10,000. So that was a huge outcry, I would say, in terms of taxpayers, everyone. And the state started looking at options of how they could come up with a workaround where they could, offer certain programs whereby taxpayers could actually, be able to deduct larger amounts or maximize their deduction for any state or local taxes paid. And several states enacted these pass-through entity taxes, pass-through entity level taxes. New Jersey did that last year. Connecticut has, I think, done it a couple of years ago. California has it. Rhode Island, a lot of states have it. I think like 14, 15 states, maybe 20 states have it now. And New York was a little late on it, but with the budget, 2021-22 budget that they passed during, I think, March, April, they did enact the pass-through entity tax, which now, so New York officially joins the bandwagon. And basically what it does is it allows pass-through entities to pay taxes, state taxes at the entity level, which can be then further deducted at the federal level. So it in effect effectively reduces federal income and allows that the state taxes to be deducted, in an indirect manner, but and then the taxes so paid are available as a credit, a dollar for dollar credit to direct partners and shareholders to offset their New York State liability. So basically, it works as a workaround However, there are certain things to consider. It's not that straightforward, not that easy. And a lot of guidance was not available early on, but then actually IRS did come up with their guidance and provided the notice where they said, okay, you know, the question first was whether, you know, this New York pass-through entity tax would be deductible or not at the federal level. Would IRS allow it or not? That was the biggest question. And then finally, IRS did come and say that, yes, it is a deductible tax at the federal level. And then there were some items and issues that the state had to clarify, which they clarified, I think, in late August. So that's when the rush started. And we were working with our clients to make sure that everyone was able to take advantage of this this program. And of course, New York had to throw the curveball at us and make the election. So, because basically it's an annual election, if you think about it, it's an annual election, and every year you have to make an election to take advantage of this. So for tax year 2021, it was the due date for election was October 15th, and combine that with the tax filing deadlines, it was pretty, you know, it was a Herculean task, but we got it done. And of course, there were so many considerations in terms of who is eligible, who is not eligible, what is the calculation, how does it work, and how do we, you know, make sure that the clients are able to make the elections online, so on and so forth. But it was you know, a good exercise, not in vain, because the clients will be saving, the you know, taxpayers will be saving a lot of money at the end. So let's go over it quickly. I just want to give a few key highlights of the program, and basically who's eligible or not, so on and so forth. So basically, this is applicable to pass-through entities. And when we say pass-through entities, it's only the partnerships and S corporations who can make the election. They are the eligible entities. This is not available to single member LLCs, sole proprietorships, and trusts. These entities cannot make the election and cannot pay taxes on behalf of their owners. That's one thing. Planning considerations, we have to look at the type of entity because the calculations are different in terms of partnerships and in terms of S corporations. We also have to look at the residency of the owners, because again, the calculations are different of whether you have owners that are non-residents of New York or they are resident of New York. Multi-tier partnerships are important too as well to be considered, because as you know, the credit is only available to direct owners. Now, when you call direct owners, they are direct partners or shareholders, meaning they are either individuals or trusts. You cannot, an entity cannot pay tax on behalf of another entity, or in case of a multi-tier partnership, that's included in that partnership or an S corporation. So if you have other entities involved, there is cannot pay taxes on their behalf. But the good thing is that you can pay taxes on behalf of the other direct owners who are individuals and trusts, and then the other partnership that missed out in a multi-tier setup can also
Looks like we lost your audio, Shashi. You may have stepped away. So let me throw it over to Don. Tell me about 199 deductions. You know, when is it appropriate to take those, and tell us what it is.
The 199A deduction is what we call like the 20% deduction. And it's an effort to bring down the overall effective tax rates applicable to business owners of pass-through entities, your S corporations and partnerships. When tax reform came about back in 2017, they reduced the corporate tax rates down from 34% for most companies down to 21%. To make pass-through entities on par with that, they reduced the applicable rates on pass-through entity income, which typically, ordinary income tax at 37%. With this 20% deduction, they effectively made it about 30%, or 29.6% if you want to be exact. But this is a deduction that's eligible on past or entity income. And it's taken at the personal returns. It's not a deduction on the entity return.
Okay, and what if a business has experienced a loss? What can they leverage to reduce taxes now and in the future?
I see Sashi's back. I don't want to steal her thunder. She's on mute.
Sorry, Sashi, I see you're back now. I just got to unmute yourself.
I'm so sorry. Apologies. My laptop just, had a technical problem there. I'm very sorry about
All right,
that.
well, welcome back. So we covered the section 199. If you could pick up the conversation on the excess business loss and the net operating loss limitations.
Absolutely, absolutely. So I just wanted to make a couple of quick points on the New York pass-through entity tax, and I'll make it quick. So basically, the tax calculation for partnerships is based on the residency of the owners. In terms where you have resident owners, they are able to pay taxes on 100% of their income, whether it's allocated to New York sources or not. And in cases of S corporations, the calculation of taxes is based on the New York state source allocated income. So that's an important distinction to remember. Also, there are quarterly estimated taxes to be paid, and that could pose a cash flow consideration for companies to make sure that they have to come up with the quarterly payments. Also, we have to make sure that the important thing about elections is that once you make the election, that's an irrevocable election. So you have to consider all scenarios, all situations, and then make that election. Because once the election is made, the taxes will become payable, and then you cannot go back and say, oh, and I have cash trapped, and we can't make we don't have the cash flows, and we can't do this. So that's an important.
You're able to change your election every year. Is that correct?
That's an annual election. Yes, absolutely. So if you elect for it, then you you calculate and pay those taxes. If you feel like, okay, this is not working out, or if you have a loss year, then you may not elect for that year particularly.
Thanks.
So we will
right. So we covered the section 199. If you could jump to the net operating loss area.
Yeah, absolutely. So there's a couple of tax laws or the couple of business loss limitations that I would like to cover quickly. There's this excess business loss limitation under section 461L that was added again, of course, with the Tax Cuts and Jobs Act. And of course, Tax Cuts and Jobs Act made some critical changes to the net operating losses, loss deductions as well. And what this excess business loss limitation does is that if you have business losses, the aggregate business losses at the level of the partner or at the level of the individual, basically, so an individual getting allocated losses from several entities will determine at their tax level whether if they have business losses in excess of certain threshold amounts, then those will be limited. So that threshold amount for 2021 for married filing joint is a $524,000 loss. The amount for 2022 is increased to $540,000, and for others, meaning other tax statuses, it's $262,000 for single, head household, those tax statuses for 2021, and $270,000 for 2022. So basically, just a quick, easy example: if you have a married filing joint taxpayer couple that have, say, $1 million in say W-2, and they have $1.5 million in losses from a partnership or an S corporation that they own together 50-50. So what will happen is, this is the clarification that was included in the CARES Act. And I forgot to mention that this business loss limitation was kind of suspended by the CARES Act for the tax years 2018, 19, and 20 because of the pandemic. And it was to make, to allow taxpayers to go back and amend or take higher losses without all these limitations, so they can free up some cash flows that could help them during the pandemic. So that was one of the measures that CARES Act kind of enacted. However, this was only applicable, or the suspension was only applicable for 2018, 19, and 20. So it's important to consider now, since it's back for tax years 21 through 26. And that's why it's very important to make sure that we are mindful and consider this and be aware of the limitation. Because as I was back to my example, if you have, say, $1 million in W-2 income from the S corp, and you have $1.5 million in losses from the S corp, what will happen is that your losses will be limited to for 2022. Your losses would be limited to $540,000. However, your W-2 income for $1 million would still be taxable as ordinary income. So while you're losing out on that deduction, you're still being taxed on the income. So it's very, very important that you consider that scenario. Make sure that the owner compensation is not more than you need to have in terms of reasonable compensation, because the IRS doesn't like that, S corp owners have no compensation and they take all draws from or all money from the company in by way of distribution. So you have to have certain reasonable compensation, but make sure that it's not so much that it pushes you into a loss situation, which you cannot really take, and you're limited there. Because there are so many levels or orders in which you can take losses. There being a basis limitation, that is the first one. That's the first hurdle. The second hurdle is at-risk limitation, whether you are at risk in the particular business activity. And then there is a passive activity loss limitation, meaning do you materially participate in the business or not? So once you clear all three hurdles, there's this new hurdle now, again, with the excess business loss limitation. So even after clearing everything, you still may be limited. So that's important. And then what happens is any disallowed loss becomes a net operating loss, which you can carry forward. So that's the other limitation that we will talk about in a couple of seconds. Once I just wrap up this topic with excess business loss limitation. Important thing to remember is that New York State, of course, decoupled from the federal CARES Act. And so while there were no limitations for 2018, 19, and 20 in terms of all these business losses, New York State still had those limitations in place. So there was tracking required to make sure that proper losses are rolling forward at the federal level and proper losses are rolling forward at the state level. And this could cause some difference in income between the federal and state taxes. So it's important to keep that in mind. The other thing which I would like to quickly tie back into is the net operating loss limitation. And the net operating loss limitation, basically, if you remember, prior TCJA or the Tax Cuts and Jobs Act was you could carry 2 years back, carry forward 20. Now, Tax Cuts and Jobs Act made some changes, and they said no more carrybacks, but carry forward indefinitely. However, there was a limitation of 80%, limited to 80% of taxable income that was introduced. So if you had annual losses, you could only deduct up to 80% of the taxable income in a year. Again, with the CARES Act, this limitation was also suspended for 18, 19, and 20 for obvious reasons of availing taxpayers extra cash by taking additional losses or going back and amending returns if necessary. So that again is back for 21 tax year 21 onwards. It's important to keep note of that. And let's tie this all back to, I would like to tie that back to the where we had a discussion about the cost segregation. So if you're having a cost segregation study done and you're generating all these great losses and all these great deductions, and if it pushes the company into a loss situation where the owners can really take those losses in the year, then it becomes, why did we even go through this exercise? So it's so important to take an overall look of the complete tax situation and not just look at isolated items. It's very, very important to look at the ownership structures, who are the owners, who can take benefits, who are materially participating in the business, who can will be limited maybe due to passive activities or things like that. There's so many considerations to keep in mind when you're doing tax planning and advisory for our clients, because we don't want that situation where, okay, you know what, we had all these losses, we did great, but now we can't take them because of all these limitations. So that's, I just wanted to kind of touch base on that. It was important because these are coming back for 21, these limitations.
Great, lots of great information for us to try to absorb as business owners and manufacturers. So, you know, we're not trying to turn you into CPAs in these presentations. We're just trying to give you all the topics that you really should be talking about talking to your tax professional about. So let's wrap up the conversation by jumping to a bit of a political thing going on here. What's happening with Build Back Better, and you know, if Joe Manchin ever comes around, maybe we can take advantage of some of the things coming down the pike. Don, you want to try to take that one?
Thanks, Ron, and thank you, HIA, for having us. Great panel, a lot of good topics being talked about. I don't want to get too political, but you know, we could certainly go into really wild tangents there. But you know, let's start with what is Build Back Better, what's in it, what's not in it, what does it mean. So you know, Build Back Better, started off as a behemoth of a tax bill where there was a lot of proposals initially set forth. The current proposal that's in there now, there's a lot of what was so-called revenue raisers. I think the most broadest revenue raiser that most of our clients will see is the broadening the base of what we call the net investment income tax. This is the 3.8% tax, which is typically just imposed on passive income or investment type income. This bill wants to expand it to also include business income. So most of our manufacturing clients, or our clients in general, are pass-through entities, and they receive, the income passes through from the company to their personal returns, and they pay tax on the personal returns. This 3.8% increase is effectively a tax increase on that income. So that affects all taxpayers that receive income from a pass-through entity. So that was probably the broadest proposal that we saw. There are other tax increases, they call them surcharges. There's a 5% surcharge if your income is over $10 million, or a 10% surcharge if your gross income is over $25 million. Certainly affects a lot less taxpayers, but it's effectively a tax increase. One of the other proposals that kind of would be shameful to take away was this, what we call Section 1202 gain exclusion. What is that? Well, if you're a stock owner in a C corporation, and when you sell your stock, if certain requirements are met, you can exclude most or all of that gain entirely, from taxation. It doesn't happen very often, but when all the facts and circumstances line up, it's a home run. You could really shelter substantial amounts of taxes. This bill would do away with that limitation for anyone making over $400,000. If you're a business owner, owning a company, chances are you're going to be over that threshold. The other one that was proposed was a 15% minimum tax on corporations. Yeah, at first glance, it sounds like, all right, well, it's they're imposing an AMT tax again on corporations, but it's really only for companies with over $1 billion of profits. Hopefully, we have a few of those clients here on the call, or some of our clients, but in reality, the impact is going to be fairly small. So that's kind of the bad stuff. So what's some of the good stuff? What are some of the things that are helpful for taxpayers? Well, one of the biggest items that we talked about earlier was this state and local tax cap, the $10,000 limitation on itemized deductions. As Long Islanders, we like to try to deduct out our real estate taxes, our income tax, state income taxes, and the most we get is $10,000. And that was a big bugaboo for our blue states where we have high income taxes, New York, New Jersey, California. So there was a lot of pushback on that. So the latest proposal on that was to increase that cap from $10,000 to $80,000. Okay, it's something, but it's not a full-out repeal, which actually a lot of people, a lot of politicians were against, because they felt that was just a big give back to some of the more wealthier taxpayers. Another give back, or another taxpayer-friendly item, was the expansion of the child tax credit. Recently, last year we had the child tax credit was expanded from increased to a couple of $1,000s. but that was a 1-year deal. This Build Back Better was to expand that, extend that for another year. And again, to make, the IRS also give some advance payments. Some of you may receive some letters or some checks from the IRS over the last 12 months, getting an advance payment on those credits. And then one of the other things that will affect a lot of our manufacturers is the R&D tax credit. So and this actually goes back to tax reform back in 2017. There was a provision that starting in 2022, companies would have to start capitalizing and amortizing R&D expenses. So all these years we were enjoying immediate tax deduction for R&D expenses, those wages, those materials, those contract research expenses. We were taking deductions right away, and that's the way it's always been. Well, starting in 2022, we're supposed to capitalize that, mean not deduct those expenses, then amortize that over a period of time, effectively increasing your taxable income. A very unfriendly taxpayer unfriendly rule. Build Back Better was supposed to delay that rule from getting implemented for another couple of years. So right now we're still stuck with that rule. There was also some other tax credits for electric vehicles and other green energies that were supposed to be expanded or improved. Some other proposals that are in the bill as far as retirement plans. If you're familiar with what they call the backdoor Roth IRA conversions, Roth IRAs are not deductible when you make a contribution, but they grow tax-free. Very popular if you can make that contribution. Some of our wealthier clients, there's income limitations that prevent you from making those contributions to those types of IRAs. And this really is a loophole in the law right now. There's what we call the backdoor contribution, where you can make a regular IRA contribution and convert it to a Roth contribution. It's a couple of extra steps, but effectively you get this a contribution or money into a Roth IRA account. Build Back Better was to shut that that loophole down. Those fortunate enough with IRA balances over $10 million, there's now going to be the proposal was that you would be forced to kind of take some of that money out. For whatever reason, they set a $10 million threshold. They didn't really want these IRA balances getting so large. So that there was required minimum distributions for those types of accounts. And the other thing worth mentioning was the increased funding for the IRS. Why on earth would we want that? That just means more audits. There's more notices, not a good thing. I agree. But for anyone on this call, and I know we have a lot of accountants on the call and clients that are relying on their accountants, dealing with the IRS these days is a nightmare. You can call them and you'd be on hold for hours and you really don't get any answers when you do get in touch with them. So hopefully with some funding, we'll be able to get some more answers. Things will get processed faster. Those refunds will get processed faster. Those employee retention credits, we're waiting months for these refunds to come back. Clients are getting very frustrated. So hopefully things will start getting processed a little bit faster if there's funding. But right now we're still in status quo. Some things that were proposed that are not in there, the biggest thing was the capital gains rates. There was a lot of fear mongering. Well, they're just proposals that they were going to make long-term capital gains rates, currently 20%, the same rates as they were for short-term or ordinary income, which is 37%. And when you factor in the net investment income tax, the additional 3.8%, you can have long-term capital gains rates going up to 40% or 40.8%, which is a big difference from 20%. The other thing that they were proposing was this pass-through entity deduction. I touched upon briefly before, this 20% deduction. They're effectively going to take that away. They will, anyone making over $400,000, they say, okay, you don't get that deduction anymore. So what happens? Well, that business income goes back to ordinary rates, back to the 37%. They were proposing to increase the corporate tax rates from 21% to 28%. Likely, fortunately, that didn't happen. And the other big thing that people worried about was when we're talking about estate planning. Right now the exclusions are $12 million or $24 million for married couples. that was going to revert back to about $6 million or $12 million. So that was a big impact. And you had a lot of people scrambling to try to get their estate planning and affairs, because if this reverts back to the lower levels, that's a lot of lost opportunity that clients wouldn't take advantage of. So you started off with, what's the status of this bill? Well, unfortunately well, fortunately or unfortunately, depending what the way you look at it and what proposals you're looking at it, many think this is dead in the water. You mentioned Senator Joe Manchin. He already said publicly he's not going to vote for this, at least not in its current form. The Senate, they're moving. It looks like they're moving on. They're moving on to other priorities, voting legislation and other items. This is not even on the front burner anymore. Some politicians are still insisting that there's negotiations happening and that they're going to do something. They're going to pass either smaller versions of the bill, they're going to scale it back, they're going to incorporate some of these proposals into other spending bills. So you may see some of this get implemented in other forms, or maybe some kind of scaled back version. Not really sure, but this is the direction that the current government is looking to implement. Now, as time goes on, the likelihood of something like this passing, being that it's an election year, it gets diminished. No one's going to want to pass something this big or this large right before an election. So there's, like I said, we may see a scaled down version later on, but who knows, what will happen. So how do clients react to some of these proposals? There's a lot of stuff that was being talked about over the last 12 months. Well, the two biggest triggers that we saw were the capital gains rates. We had a lot of clients selling stock, selling businesses, really insisting or pressuring advisors to accelerate closings if they were selling a company or buying a company. They were trying to get that done as quickly as possible and putting a lot of pressure to make that happen because they wanted, the current favorable tax rates. And as I mentioned before, the estate planning, there were a lot of people that were trying to take advantage of the available exemptions, and they were gifting a lot of their stock in companies or other assets to trusts that they were forming. They were trying to get that done all before year end because they didn't want to see that opportunity lost, because they're not sure when that was going to come back again. The other big discussion item was deductions. If tax rates are going up next year, maybe I wait until next year to do that cost segregation or take that bonus depreciation or maybe pay some of those bonuses. That tax deduction might be better suited next year when tax rates are higher than this year. Maybe that will be the case, but fortunately, in many of those cases, you didn't have to decide before year end. You can still do that cost segregation study now and apply it to assets that were placed in service last year or even prior years. So that's something that's still on the table. So what are some of the key takeaways on this? Well, we're still at the maximum rate for individuals is still 37%. Capital gains rates are still at 20%. While tax rates didn't necessarily go down, we've been hearing about all these higher tax rates over the last 8, 12 months. It almost feels like a tax reduction that we're back to where we were. So right now it's still status quo. It might be that for a little bit. If the tides turn this election and there's more Republicans in Congress and why not? We'll see what happens after that. But right now we're at the status quo. The SALT cap, unfortunately, is the state and local tax cap is still $10,000. So we're still stuck with that $10,000 deduction. But as Sashi was talking about, this pass-through entity deductions, this is a nice workaround. It's a lot of extra work for us accountants and put some impact on cash flow, but it is a nice workaround to really help get some additional deductions for the state and local taxes. That pass-through entity deduction, that so-called 20% deduction, we can still take that, and there's no limit on how much that deduction is. If you have a $10 million income for the year, you get a $2 million deduction. So there's no limit on that. We can still do backdoor Roth IRA contributions if that's something that's enticing to you. And unfortunately, the R&D expenses right now is still in a situation that we need to capitalize those costs. So when we start planning for income for 2022, you just need to be mindful that that might still be in play. It is a very unpopular rule. There's bipartisan support to get rid of that rule. So you may see something in another spending bill that just has one of these, one-off type tax provisions that does away with that. So we'll have to kind of wait and see, but that's something that's still out there. And that net investment income tax, the 3.8% tax, that is still applicable to only investment income and passive income. So the next thing I wanted to, go ahead, Ron.
That's great. Yeah, appreciate the update, because it's a few months ago we were all kind of wondering what was going to be the impact of this new tax bill, but like you say, it looks like maybe it's gone to the back burner at this point. What about?
Can I just make a quick point on just a quick point? So when we were talking about the sole deduction for the $10,000 and the pass-through entity tax, what's important is that even though they may increase the limit to 80,000, we'll see if that happens. But we still have to keep in mind that there are those AMT limitations, and some people may still be, not be able to take be able to take advantage of that deduction because they may be subject to AMT at individual levels. However, the pass-through entity level tax does not have that limitation. That's something that they still should consider if they can pay it through the entities. Just wanted to make that quick point there.
Yeah,
great point. And that's what the pass-through entity deduction might actually yield to a much larger deduction. If even $80,000 could be pennies compared to a very profitable company paying a lot of New York State, California, or some of these other states that have these types of deductions available. That other deduction, that pass-through entity deduction, could be substantially larger. And like you said, it doesn't impact AMT. It just reduces your federal taxable income, so it's really nice. So we certainly should be taking a look at those for all the states that apply.
Yeah, what about green energy taxes? You see all the car companies going to, we're all going to be driving an EV, I guess, by 2025 or 2035. What are some of the incentives available out there?
Well, electric vehicles have been around for, I don't know, 10 or so years. So they seem to be getting a lot more popular with Tesla. You see a lot more Teslas on the road. Those are certainly the most noticeable EVs that are out there. So the IRS has tried to help subsidize the cost because a lot of these EVs are a little more expensive. So they've made a tax credit available for the individual, the company purchasing these EVs, up to $7,500 per car, depending on the battery capacity of the car and some other items. And it's actually on a car by car basis, meaning that as the more a manufacturer sells a particular car, that credit starts to get phased out. So when a car is first introduced, the credit could be up to $7,500. But then as that car becomes popular and they start to sell a lot of them, that $7,500 starts to get reduced. Again, Tesla seems to be one of the more popular EVs out there. Since so many of them have been sold, a lot of the Teslas are phased out for tax credits. So if you're looking to get a tax credit, you may have to look to some of the other manufacturers, but it's something that is out there, and it is it's a way of defraying some of the additional costs that because some of these EVs are more expensive than their gas-powered brethren. Along those lines, when you buy an EV, you have an EV charger. Companies need to. I see a lot of these. You go to these parking lots, and there's spots specific to those that own EVs, and there's various chargers in those parking lots. I even see them at Target now, which is crazy. But some clients are installing them because some of their employees are starting to buy some of the EVs. So there's actually tax credits available for the EV chargers as well. That's 30% of the cost of the charger, or up to $30,000, and that can go up to if you have multiple locations, you can really start to maximize that credit. This credit, unfortunately, is only good right now through 2021. Has not yet been extended for 2022. So if you're looking to do it, right now that credit wouldn't apply for 2022 purchases, but if you did in 2021 or even some of the prior years, if you weren't aware of it, maybe you can file an amended return to claim some of those credits. New York State also has a credit available as well, up to $5,000 to help to defray the cost. So between the two of them, you can help defray some of the cost of some of these EV chargers that you're seeing. The other thing I'm seeing a lot of, probably more so, is solar panels. A lot of companies, especially manufacturers that have a high need for energy sources, we're just trying to cut down the cost of that energy, are installing solar panels on the roofs of their building or in their parking lots or warehouses. And right now, if you're starting construction in 2022 or started construction last year, you get a federal tax credit of 26%. If you're looking to start something maybe next year, that credit will drop down to 22% for construction starting in 2023 or later. If you had something that was started a few years ago, I guess it was before 2020, that credit used to be 30%. That's a credit based on the panels, some of the ancillary equipment, and the installation costs. So it's a nice way of defraying the cost of those panels, which they can be expensive, especially some of these larger panels. What companies often do is, while they're or right before they install these solar panels, they also fix the roof, or they do some roof improvements. Unfortunately, the cost of that roof would not count towards the credit, but you might be able to take some 179 or other tax benefits to help defray the cost of the roof. But there's some nice credits available on the solar panels. The cost of the solar panels are eligible for 179 and bonus depreciation. In this case, you're going to want to take bonus. If you take 179, it's considered a basis reduction, and that will effectively reduce your credit. So you can still take bonus depreciation on those assets. And you will have to reduce your depreciation a little bit by the credit that you receive. You can't get a double benefit, both the deduction and the credit. There's also some New York State and New York City programs available. You might be able to get some rebates from the utilities. If you are talking to some firms, with the solar panels, you can certainly reach out to them, get their all the latest on all the proposals. Because New York State has the New York State Sun Incentive Program. New York City has a property tax abatement program. So there are other things available to help defray the cost of the solar panels. And the other thing that it's been around for a little while, I haven't seen a whole lot of companies actually take advantage of it, is if they're trying to improve the energy efficiency within the building. We talk about lighting or HVAC or just the general insulation of a business. This is what we call the 179D program or deduction. It's similar to what Sasha was talking about with the 179, where you kind of accelerate deductions. This is just another program to accelerate deductions. So a lot of these types of improvements, when you make them to a building, some of these costs are going to be amortized or spread out over a 39-year period, which that really doesn't do for us much now. We want those deductions now. So this 179D program can help accelerate some of those deductions into the year that you place into service. And the way they look at it, it's up to $1.80 or so per square foot. So depending on the size of the building that you're improving, you accelerate some of these deductions. This is not a credit like some of the other programs where you're just getting money back in addition to what you've already spent. This is really just an acceleration of some deductions that you would otherwise normally get, but you get in the year that you place this stuff into service. If this is something you're looking into, you're going to need to get an engineering study similar to like a cost segregation study, where they need to evaluate the building before and after. And there's if there's a dramatic increase, like a 50% increase in efficiency, that's when you really maximize the deduction. If it's something less than 50%, then you get a small deduction, but you're still getting more of a deduction overall. And it's also, again, not to pitch cost segregation studies again. If you're doing improvements this large, it's worth getting a cost segregation company involved, because there's probably a lot of improvements or expenditures that you're making that will probably qualify for a fast deduction anyway, above and beyond the 179D program. So those are the more popular programs I've seen clients take advantage of. The solar panels, certainly a big one. EVs you see a little less of, but there's certainly, seems to be a lot more of that happening these days. So it's something just to keep an eye on for.
All right, thank you, Don. Well, we've covered a lot of territory here with taxes, tax deductions, credits. So let me just make a last run around the panel here to see if we had any parting thoughts to share with the group, and then we'll call it a day. We will have a recording available, so if you wanted to review some of the information, or maybe you weren't able to start at a certain time or had to leave early, we'll have that recording available. We'll send out to everybody's registered. So let's start with John. Any parting thoughts, any other takeaways that you want to leave with the group, John? You got on mute.
No,
there,
got it. No, none other than, it's tough to really go through all the specifics on these types of webinars. These are more for us to kind of let you know what's out there. And then, you have Mazars on the call, Grassi, of us, Such Improvement, come to your trusted advisors. If you have any questions on any of the topics we discussed today, see if you qualify or if they're already being taken or ways to explore them. This is just raising awareness. So thank you everyone for coming. Thank you, Ron, putting all this together, HIA, Ignite-LI. It's always a pleasure working with you guys. The core mission of educating manufacturers and helping them to thrive on Long Island is shared by all. So thank you very much.
Absolutely. Thanks, John. Danielle, you want to give us any parting thoughts with your credits you talked about?
Yeah, sure. There's a lot of great information that was shared today. A lot of information overall. So just ask questions from a CPA standpoint to being the actual client. Ask your advisors, ask other advisors. We're all in it for the same reasons, to help manufacturers, to help clients, to help individuals, to help small businesses and medium to large. So don't be intimidated to just ask questions. There's a lot of new information coming out constantly, and there's no way that we can all be experts and wrap our heads around everything. So the person next to you might already have a leg up on it, and the person on the other side of you may know something else. So you can all coordinate and have conversations and work together to help inform and educate.
Thank you, Danielle. Thanks for some great information. Shashi, any parting thoughts?
Yes, Ron, thank you so much for having us today and be able to discuss so many different tax strategies and tax saving, options and possibilities available to manufacturers, taxpayers across the board. It was a great discussion today, a lot of good thoughts. And again, same thing. It's important that we talk and stay in touch with our clients. Clients stay in touch with us if they're thinking about something. Any major capital expenditure, any capex, or any major changes in terms of labor or any production, processes, things like that, any R&D type situations where they might not be sure. It's important that we talk with any one of us. Danielle, of course, is an expert in the area, and just make sure that they talk to us. They kind of keep that conversation going, and if they're thinking about something, talk to us. Timing is important. Not to it's always good to be proactive and think about it, plan ahead of time. Make sure you're making good planned decisions and not missing out on something, because sometimes there may be some things available, but it's now too late, to do certain things, especially like the perfect example is the New York State PT tax, the pass-through entity tax. Well, if some taxpayers made the elections for that tax back in October, they're in for good tax savings, but some people may have not known about it and have lost that opportunity for at least that year. But going forward, they have become aware of it now, and they should be able to take advantage of it. So that's it. Timing is important. So keep the conversation going. Thanks so much.
Yeah, good advice, Shashi. And Don Crotty, if you could give us some parting thoughts.
Sure. Thanks, Ron. There's a lot of good topics discussed today by all the presenters. And by no means anyone should kind of just run with the information and just start implementing strategies. there's a lot of, this is a great forum for, I heard this or I heard that, and these should be great conversation starters with your advisors and your accountants, and see how they can apply it, because the manufacturing companies are a nice beneficiary of a lot of these types of proposals. You know, they're very capital intensive. There's a lot of payroll involved, and there's a lot of incentives available to those types of companies that have they're spending a lot of money on people, on CapEx, even on real estate. They tend to own various locations. So there's a lot of incentives available to help accelerate deductions, or even additional incentives where you start getting tax credits, where you're basically getting money or subsidies back from the government. So it's worthwhile having conversations, just talking about what could be available on a variety of these things. We go too much into state and local beyond but these even more stuff that we could talk about, state and local taxes, where you can help save on some taxes on top of everything we talked about today. So good stuff. Thanks for having us.
Great, thanks, Don. Helen Torkos asked if we could share your contact information. So I'll share the presenters, the panelists' contact information with the group. So if you have any individual questions, certainly reach out to your tax experts or the tax experts here on the panel. Thank you to Ignite and Hauppauge Industrial Association Long Island for hosting us today. My name is Ron Loveland. I'm the co-chair of the manufacturing committee here at HIA, and also run Summit Safety and Efficiency Solutions. Best wishes to everybody. Thank you for joining us. Best wishes for a happy, healthy new year, and stay in touch, and let us know if we can help you out. You all be safe. Enjoy your day.
Take care, Ron. Thanks.
Thank you.
Thank you, everyone.